Okay, can you guys see my screen? Yep. Okay, perfect. And look, I know most of you guys don't want to put your camera on Monday or participate. If you want to participate, that would be better. Or just put it in the chat box, and I'll kind of like give your answer to the group, so it gets more it gets more interactive. Okay, so we'll start with chapter 6, and again, this is your second quiz 5%. Like it doesn't mean that much, but it's more about understanding the concepts. So for your midterm and your final, because the exams are cumulative, it's really important to like know this so that in your final it'll come back and that you don't have to restudy everything for your final. Okay, so let's get started. So I mentioned this a little bit last time. Chapter 6 engagement. I think we'll redo it because we do have time. So okay, chapter 6 acceptance, planning, and materiality. Jeez. There you go. Okay. So what is client acceptance and continuous? So before you take a new mandate, your partner does that at the firm. You want to be looking at, as an auditor, you have ways to have SAE, right? So that's something that your professor really wants you to know the acronym. And you want to minimize any kind of liability. You want a strong reputation for being a good auditor and cost reasonable, still remain competitive, and it's a business. And you're doing this because you want the most evidence possible by putting the least time possible, because at the end of the day, you're going to have to get paid and you're an expense to the company. And they want to be competitive against the other big fours. So that's why you need a plan. And otherwise, you'll be vulnerable to these 3 risks. So client business risk. But this is not really about the audit. It's just the client itself. You have to see like what's the inherent risk of it, the engagement risk. Like if you're going with this client, what's the possible like errors or like red flags that could happen? And then the risk of material misstatement. And this is like when you're doing the audit, what should you put efforts in, or what kind of red flags you could definitely see in the client's work? Okay. What is client acceptance and continuance? So when you continue with clients, there's steps that you have to take. But let's say that you're continuing with the client, but at the same time, it could be like a new case. Well, you have to look at beforehand, you have to do a client investigation, see if everything was fine or not. Number 2, successful auditor contact predecessor. So you have to talk with the other auditor beforehand. And usually you ask permission from the client, but if he's not telling you for X reason why he's changing, that's possibly a red flag. Annual evaluation for ongoing audits of existing clients. You look at the client, like, do you want to take him on? Is he not paying enough for the mandate? Maybe you want to drop him. Past disputes. So let's say that before, like last year, he was arguing on IFRS revenue recognition, and you were like, no, I want this information. And he was like, no, I want to do this way. Then maybe you want to drop him. Integrity issues may prompt discontinuation. So if you think that the tone at the top is not acceptable and there's more problems than words, maybe you want to drop him again. And independence concerned. We talked a lot about independence in this class, and then performing independence threat analysis. What is the planning for the overall audit strategy? Auditors should develop and document the strategy. So this is just like saying that as an auditor, you want to set staff for engagement, enough people, not too many, evaluate need for outside specialists. So let's say, could someone tell me like what kind of outside specialists you would look for the most in terms of audits? That's always recurring most of the time that you would bring out. You put in the chat. What do you think? What kind of outside specialists you might need? The bank? The bank, yeah, but the thing is that the bank, it's more about audit procedures, right? You would be like, okay, I want to test this, so I'll ask the bank for like a bank confirmation. But like, what is someone that you will pay to work for you as an auditor? Specialist in goodwill impairment. Yes, so that would be one. So that's more about like valuation, a consultant, valuation consultant. Like, let's say two companies are being merged, and then on your client's balance sheet, there's goodwill. You want to test that if the number is accurate. But usually this doesn't like occur that often. But yes, Patrick, that's a very good answer. Valuation. But what's one that like almost every audit, like you need this guy, this person? Okay, I'll give you guys a hint. Like, okay, actually, I'll just give it. It's like the IT person, like the IT. There you go, IT specialist to understand its infrastructure. Yeah, exactly, Elizabeth. Right on the point. I just said it like 1 second before you, but you really need someone that's an IT specialist, because if you look at how companies run, they're very much IT dependent. So if you don't know IT, you got to bring someone that's a specialist for it. Evaluate reliance on others. So like, let's say this for let's say the other one was KP, and then you work at Deloitte. Can you rely on their work or not? What are the factors that can help auditors assess risk? So these are just like an overview picture. So NOB, this is Jack Martin's favorite acronym. Knowledge of the business. You want to know how it functions. Industry. Look at externally what could happen to the business. What are the dangers of it? Organizational structure, complexity, if the company's in like multiple countries, business model. Straight up, how can the company make money? Understand how everything flows in the income statement, balance sheet, management and governance. So this is the tone at the top. How does management talk to their employees, how they operate? And what you could do is look at the minutes, and even in the minutes, let's say you could look at the strategy of the company. So let's say you're talking about acquisitions, right? So this is something that there could be, as an auditor, important to know. If two companies are merging, then your materiality changes. So a lot of factors there, and you can look at the MITs. And then performance measure, like what are their KPIs? So how do they evaluate the success of their business? Is it, for example, let's say 2 stores? Okay, so guys, if I tell you like 2 stores, how can I evaluate their KPIs? And Cleveland the Grand, yeah, I'm posting the recording at the end of the tutorial. So what are KPIs? Revenue per square foot, exactly. So if you're looking at the company, if they have 2 stores, one's in Mont-Tremblant and the other one's downtown, the only way to do it is with sales per foot, or other measures as well. Yeah, what are the factors that can help auditors assess risk? Risk assessments, procedures, and information from other sources. Audit team discussion. So you just talk with the team, see if there's any, you huddle up and you talk with them. Analytical procedure. So this is a very good one. And I like this one because one, is cheap, and number two, it can help you a lot of time. So you could look at, let's say, I don't know, like, let's say there's a big change in numbers from last year to this year, then immediately you're going to flag that and be like, okay, well, maybe I'm going to be doing more work here. Client objectives and strategies, reliability of financial reporting, effectiveness of efficiency of preparation, yada yada. And you're looking at all these things and you'd be like, okay, well, if there's too much risk, I'm going to decline the engagement. And always do this before the audit planning, not when you're doing it. Otherwise, let's say you need an IT specialist and then you just can't have an IT specialist, then you're out. Okay, what is the importance of materiality for auditors? Okay, so when we're talking about materiality, again, always think of the users. And let's say that there's a lot of little mistakes. You have to assess if all these little things for the users, is it material or not? And your materiality again, you have to set it beforehand, before you do the actual audit. So in the audit planning, but let's say you're doing the audit, and then you assess like 1 million is the materiality, and then the FBI comes in and raids in all the documents and everything. Well, it's not because you did the audit before and you had a number that's going to stay. Now you're going to have to change everything. You might be like, oh, I'm going to have to lower my materiality by 90% because of what just happened. So always something that has to be flexible. Okay. So that is materiality. Maybe I'll talk a little bit more about performance materiality. Is someone like not too familiar with like performance materiality, or like why would you use it? Yeah, okay. So Stelly is not sure. So uh if I could resume like why I would use performance materiality is this. I know I will not find all the errors at the organization I'm auditing. So I want to be sure that I don't miss anything. And you'll see the slide after, it's all like criteria that why I would use PM. Okay, so like let's say I have $1 million in overall materiality, and then there's an error of 999K. Well, I'm not gonna sign off and be like, oh well, since it's below, I'm gonna be like, oh, it's fine. No, I want to be sure that I'm not missing anything, and I'm gonna be using that performance materiality just in case of it. And it's kind of like your buffer, your margin of safety. And if you're not sure, just use your performance materiality on this account, on that account, right? You can have an overall materiality for the whole audit, but like let's say I do analytical procedure and I see like there's a risk here, bam, I'm going to use my performance materiality in that account, let's say. Is that better? Okay, I'll assume that's better. Patrick says Elizabeth is good. Okay, so here are all the, right? So in the exam, like if you have to remember something, like maybe a little bit of these and be like, okay, I'm going to be using the PM because there's progress, right? There's a history of identifying the statement. And so, the long question about materiality, yeah, you have some stuff, but then you're going to use the performance material that will bring it even lower if these are things that are like important in the case, the overall picture. Okay. And end of audit, look at all the misstatements and compare, the overall materiality or the PM, whether which one you're using. And if everything is fine, that's an unmodified opinion. If their misstatements are not corrected, and material, qualified opinion. So when I say misstatements are not corrected, so that means that you're talking with the client and you're like, can you fix this for me? And you're like, and he says no, then that's a qualified opinion. A particular materials error on specific process is a qualified opinion, right? So it's material errors on like, let's say on AR, the AR cycle, right? Then that could prompt me to give a qualified opinion. And if there's many small errors, but combined are material, that could also be a qualified opinion, as I mentioned before. And if there are many material errors, you have an adverse opinion, which is even worse. Okay. So let's move on. Is there any questions for these slides for chapter 6? We're good? Okay. Move on to chapter 7. Okay, you guys are lucky because he took out chapter 8. Chapter 8 was, I think, one of like the ones that students like had difficulty understanding. So good for you guys. Let's see. Okay, can you see my screen? Yeah. Yes, no. Yes, perfect. Thank you, Lee. Okay. I'm just gonna look. So this is the risk. This is the audit risk model, and you're gonna be using it a lot. Okay, so if there's a good time to understand it, it's now, because you're also gonna be using 465. Now I'm gonna ask you some questions. In here, what are things that the auditor like can modify or has an impact on? Can someone tell me? Detection risk, detection risk. Okay, is that all? Is that all? Only detection risk? Everyone says yes. Well, you're wrong. You could the audit also has kind of a say on the audit risk, right? Because what is the audit risk? Can someone tell me what's the audit risk? If someone wants to unmute themselves. Yes, Elizabeth?
Is it the risk of potentially giving an unmodified opinion when it should have been modified? Like,
Yeah,
or not finding a material misstatement?
yeah, that's exactly it. And how you could do it is see it in percentage. Let's say that you put 1%. That means that you're giving yourself like 1% chance of getting a mistake. But if you give yourself a 10% audit risk, that means that you get 10% of having a wrong answer. Uh, you know, you have more leeway. But again, you could like change these things. So there's a detection risk, which could lower or make it higher. Yeah. But there's also the audit risk. The two things that you cannot touch is an inherent risk and the control risk. So let me ask you guys this. Why would I take 1% rather than 10%? Because it looks like, no, why would I take 10% rather than 1%? Because no, 1% is better, right?
It'll depend on the company that you're auditing. Maybe they have a good reputation. They don't have a lot of changes year to year, so you could trust more the numbers that you had before, or you had a good feeling that nothing will change, so you give them a little more leeway.
So that's very like that's an answer like from a book. Now, Patrick, tell me an answer in real life. Why 1% versus 10%? It's one
Do
word.
more work versus less work.
Exactly. And work is what?
Time,
Time is what?
money.
Exactly. So sometimes companies like don't need an audit that's like that's let's say Apple versus the company like the for a bank loan, right? A company that wants just a bank loan might have an audit risk at 10%, but let's say for Apple it's at like 1% because there's so many users that you want to make sure that all the information is reliable. Okay, and if I ask you guys, the calculation that we're doing, the long questions of materiality, where does that appear here? Right? We're taking like 45 minutes to do one problem, but what are we even doing that for? Where is it in this table? Where's materiality? Where's the materiality?
Is it the inherent risk?
Inherent risk. So Patrick, the materiality, you're doing all these work. Who's doing it? You
The
are.
auditor?
Exactly. The auditor has to touch
Oh yeah,
which
yeah, I understand. Okay, detection risk.
exactly detection risk. And I'll talk more about it, but detection risk, like look what I put as a picture. I don't know what this is called, but like when you go to the beach and you're like looking for gold whatsoever. So let's say your thing is you want it's very sensitive, so you might change it, adjust it so it doesn't beep too much. But let's say it's not hearing anything, so you want to make it more sensitive, so you're going to change it, you're going to adjust it. Well, detection risk is the same thing. You're looking at your risk of material misstatement, you're adjusting it. Is inherent risk high? Is the control risk high? And that's how you're going to be doing your detection risk. So detection risk is the BS monitor, right? The bullshit monitor that you're looking through your client, and then you're going to be adjusting it if the client's reliable or not. Okay. Are we good for this? Any questions? Perfect. Okay, so we'll move on. Okay, so I'll give you an example here. Okay, so example here. So we're looking at this in percentage. Okay, so I don't know if Jack Martin did this in his class, but he did it, and like I was like, Jesus Christ, it all makes sense when like he presented it. So like example one, let's say you give yourself 5% audit risk. The inherent risk 50%, the control risk is 50%. What's the detection risk? Like I'll just give it to you because like this is math at this point. So 20%. Okay. So you do 5%, divided by 50% times 50% because like there's an equal sign between audit risk and inherent risk. But now let's see example two. 5% equals 50% of inherent risk and control risk is 100%. Yeah, so Lee says it's 10%. So now your control risk went up. So what does that mean? Your detection risk has to go down. Right? So you're always adjusting it based on these criteria. So example three, if 5%, 50%, then the other one is exactly 100%. So you're increasing it materially because here, it's low. So the numbers that you had is going to be very high, meaning materiality is high. So there's less work to do. All right. Is everyone good with this? Yeah. Perfect. Okay. Yeah. So the audit risk, auditors can also say 100% of the time there's no material misstatement. That's the error that you're letting yourself, because auditors are not perfect. They're humans. They can always make a mistake. But how much of a mistake are you giving yourself? Okay, risk, inherent risk. So in the audit risk model, you're going to be looking like the overview. The goal is to determine the risk of material misstatement for the overall statements, right? The financial statements. And this is not a precise tool. Again, it's like the beeper that I told you before. You're going to be adjusting it to see about how much materiality can you find and how much work do you have to do. And before that you really get into like the trenches and look at documents, look at the overview. What is it? It's management integrity. So this is like the tone at the top, or economic conditions that could impact every account. Like let's say COVID. If you know that there's COVID, like there's so many things that was impacting, like accounts receivable, accounts payable is very pervasive. Risk of material is usually a combination of IR and CR. So you saw that before. We do look at specific assurances balance, but there are issues that could allow material misstatements overall. Okay, and we'll see in the exercises how could that happen. Yeah, so detection risk. So this is the risk that audit risk procedures will not be effective because this is what you're doing, and that could impact the audit risk. So if you make a mistake, you might not lower the detection risk enough. And this is how auditors would respond to risk. And the presence, because if you think of a business, there's inherent risk, and then there's management that are putting all these controls to mitigate that. But if they're not able to mitigate it, then you as the auditor, you got to come in and lower that detection risk. You're the last line of defense for the whole mandate. So inherent risk is everything that's externally, right? So we have to separate that from the control risk and detection risk. Detection risk, auditor, control risk, management, inherent risk. Management can't do anything except putting controls. But inherent risk is the business outside, like how is it doing? If you're selling jewelries, well, the fact that you're dealing with items that are very expensive, that's an inherent risk. And control risk is that management has not put in control in place to prevent or detect material or detect errors in a timely manner through their internal controls, right? So prevent or detect errors in a timely manner. So that's important. Auditors cannot control what, so again, two things are the control detection risk and the audit risk. So this is for your case, and they could be asking you like what's materiality, yada yada. You do the calculation, and then they could be like what's inherent risk, and you have to give examples. You got to take it from these relevant inherent risk factor: complexity, subjectivity, change, uncertainty, management bias, and then you got to explain. But for exam, memorize these concepts for inherent risk. And then what if inherent risk, what is inherent risk assessment? And so you could have like pervasive risk. So that's very like overview picture, something that could touch many accounts, right? So let's say poorly trained staff, all your interns for the summer, they're just eating pizza and partying all night. And then you want to make them work on something and then they touch many accounts. Well, they could make mistakes all over the place. Control deficiencies. You have like management override. So let's say that there's controls that are not being, they're properly there, but they're overridden by management. Well, what's the point of having them? And you can have management touch a bunch of stuff and corrupt everything. Passing statement. Okay, then you have risk of material misstatement at the assertion level. So this is in all the accounts. So again, here you see complexity, subjectivity, change, uncertainty, and these are significant risks. So this is again like an overall picture. A transaction with multiple acceptable. So this is more like a generic risk that could come for each issue. Accounting estimates that deals more with like IFRS stuff and like professional judgment. And at the end, you want to be like, okay, is your based on these case factors, is your inherent risk high, level, high, medium, or low? And you want to look at compared to last year, because like if you tell me, yeah, okay, it's high, but like, yeah, it's high, but based on what? You have to take a look at last year and be like, okay, well, based on last year, it's high. So this year we could have to do more work. So that's how you should speak like to a partner, your manager. That's how they want to know the answer, not just high, low, or medium. Okay, so let's say you do see that the risk is pervasive. What are you going to do? Well, you could assign more experienced staff. That means put more people on the case, maybe put associates instead of interns, closer supervision and review, look more at them, further audit procedure. So you see, you want sufficient appropriate audit evidence, but with the least work possible. So maybe here you don't have a choice. We have to increase the numbers of testing, so that's time. Heighten the level of professional skepticism. Yeah, put your judgment hat. Increase involvement of audit partners and the manager. Yada yada. Consider if change will they have to be done or not in the overall audit strategy. Right. Again, materiality could be flexible. Yeah, is flexible. Sorry. So it could always be adjusted. So this is for the responses at the assertion level. So this is more like within accounts. Like if you see like this a red flag, you could develop test of controls, and then do more substantive audit procedures to test the specific assertions. And you would, management assertions, cost of transaction and cost of the account balances and disclosures. Okay, and now we're going to talk about fraud. This for each case that you're doing on audit, you always have to discuss with the team about the risk of material misstatement because of fraud. Make inquiries to management regarding. So you got to talk with management and be like, do you have any fraud? And sometimes they could be telling you yes or no, or sometimes, if the fraud is like, right. Actually, let me ask you this. Do you report is fraud on anything? Like if there's like $1 of fraud, like do you have to report it or not? As soon as you have $1 of fraud, like do you have to report it? No. Sophia says no. Why is that, Sophia, do you think? You could just write in the chat box.
Oh,
Or
I'll just say it because it's easier.
Yeah.
I would say no, because it's considered like the trivial. It's like it's amount like not significant enough to like be recorded or reported or whatever.
Yeah, absolutely. So materiality also considers fraud. So let's say that you're Apple and then the guy says, oh, well, I reported $10,000 of golf expenses when I shouldn't, or something like that. But if it's on billions of dollars, like am I really going to take the time and look at all these little mistakes? No. Fraud is also based on materiality. That's what you have to remember. Evaluate the risk for revenue fraud and management override, and understand the period end. Right, so management override. So if there's any way that management is not assessing the controls, respecting it, and understand the period end, because sometimes you could do like year-end adjustment, and in 2008 that's what happened, where all these companies, they like debited some stuff and created some stuff just to make the accounts look good, and like the others didn't do anything. So year-end transactions are really important to see for to look out for fraud. Okay, fraud, honestly, you don't need to know that much. I put a case in the doc, in the Excel, but just know that there's incentive, opportunity, rationalization. And like, let's say they give you a case, you have to be able to identify like which one's incentive, which one's opportunity, which one's attitude and rationalization. Okay, just these three. And then there's two types of fraud. Misappropriation of asset. So this is employee fraud. So there's someone employee stealing something from the warehouse. Or there's fraudulent financial reporting, which is management fraud. That's management like cooking up the books. Could someone tell me what's like the biggest difference between these two? Like if you're an auditor. Intention. Well, I think both of them is the intention, right? So like, let's say you want to steal stuff as an employee, like from the warehouse, or you want to, you know, cook up the books. Both of them have the intention. Yes. So we have the value. Yes, the value and the scale of the fraud. So if you look at misappropriation of asset, these are like low dollar amounts, but could happen like a lot. But fraudulent financial reporting, that's something that could happen like once or twice, but it could be like millions or even billions of dollars. So Elizabeth, one affects the financial statements, the other one affects cash.
As
So
in, like,
yeah.
the financial statements, it will affect the users of the financial statements versus the misappropriation of the assets, since it's all to a certain degree nominal amounts, won't necessarily affect the users of the financial statements.
Yeah. So absolutely, you're right. Exactly what you said. So there's two things, but like the biggest thing that you should retain is that misappropriation of asset, it happens a lot. But yeah, it does also impact a lot the users of the financial statements. Very good answer, guys. Okay, respond to fraud at 3 levels. There's the overall response. So like, let's say the FBI raids the firm, the overall response is that we're changing materiality. We're not going to be taking the same as before. Response at the assertion level, so we're going to be looking at the accounts. We could change dramatically each account, the materiality. Responses related to management override, and again here, examine all the adjustments, review accounting estimates, significant unusual transactions, and then the most important one is segregation of duties, right? So Elizabeth mentioned about cash. Cash, it's a big issue if you don't have segregation of duties, right? And then the types of fraud, auditors are concerned with suspected fraud. Yeah, you don't determine if there's fraud or not. Let's say that you think that there's fraud, you leave it to the forensic, you get out, and then they're going to be telling you like, no, is there a risk of fraud? And then after that, it's the court that decides. Any questions for this chapter, guys? No? Okay. I think we have one more. Okay. Yeah, assessing the control risk and designing tests of control. So now we're looking in, we talked before about the inherent risk. Now we're going to control risk, which is management's responsibility. Okay, so what is this responsibility for auditors in understanding internal controls? Auditors are required to obtain an understanding of controls over financial reports. So they have to understand, like, let's say, does anyone know what's like a trial balance here? Or like comp 17 and it's giving you like PTSD at this point. So trial balance is like all the accounts, all like the debits and credits. Well, they had to know like how that goes from debits and credits towards the income statement and the balance sheet. Because at the end of the day, you're closing all these trial balance and they're going there. So you have to understand like how everything flows in the business and also know the controls that are relevant to the audit, right? You're limited in time. You can't be looking at everything. You really have to do a good audit planning to say, look, I'm going to be looking at this part, that part, and that part. And there's two things. You have to understand the internal controls, and then you evaluate the components of the system of the internal control. So is the design good? And is it functioning well or not? So what is the control risk assessment? So this is really just like, again, as an auditor, everything you're doing, you have to have an overview picture. And this is the control risk assessment. You're making a preliminary assessment on the control risk. And if you have a low control risk, then again, you have less procedures. That's why you're putting a lot of effort in this. So before making the preliminary assessment of control risk, right, make sure that management has integrity. If they don't have integrity, right, well, I'm not going to be, you're not going to be relying too much on their controls. Make sure is there any deficiencies regarding to accounting records? Is there any mistake? Once there's a mistake, most of the time there's more than one mistake. Look at IT, see if we need an IT specialist. So this is everything that's external. That's why, the control risk, you're talking about a lot of IT stuff. You want to make sure that you have a specialist for it. And then you do a conclusion. Is the risk high, medium, or level, or high? High, medium, or low. And weak foundation in terms of internal controls. Yeah, so think about it. Let's say your internal controls, it's kind of like the foundation of the house. It's the same thing with management integrity. If these are bad, then you're mostly going to do substantive. You're not going to be doing too much of the test of controls. But you want to use the test of controls because it'll save you some time and money. So as an auditor, like, what are your tools that you have to assess risk? Okay, so you have the interim procedure. What do you guys think is the interim procedure? What's the like interim part of the work? Someone want to try? Like, what's the interim part of the audit? Did your teacher talk about this or no? Yes, no. Put in the chat.
No.
No? Okay. So the interim period is like at the end of the year. You're gonna be looking at like if all the controls, can you be relying on it or not? Okay, so let's say you have a December 31 year end. You cannot wait until January to make that determination. Are we going to be using the controls or not? So like maybe 1 month, 2 months, 3 months before, you're going to be testing all these controls and be like, oh, can I rely on it? And how are you going to do that? Well, it's this whole freaking chapter. Okay, inspection, inquiry, observation, reperformance, IT journal. You're going to be looking at all these things and be like, can I look at the controls of the company and do less work because they're good or not. Okay, so we're going to be going like one by one in each. Okay, interim procedures, interim part of the work, period that's before you end. Are you going to rely on controls or not? Basically, if the auditor will be relying on interim controls, a part of the audit strategy, you have the interim testing period, and that's the period where you would try to see if you can understand all the interim controls, test the interim controls, and do all these little evaluations to see if you could use their controls or not. Okay, so there are many techniques. So one of the techniques, and as an A1 accountant at a Big Four, your boss might be like, Kim, could you do a walkthrough for me? And a walkthrough is that you take one transaction, let's say invoice number 445, and he's gonna ask you like, how can this flow in the internal controls, right? So you're gonna be like, oh, it goes into that account, that account, that account. So again, just like a walkthrough of like how the support goes in the controls, and really like what he wants to know is how does this all flow, and like is there any like red flags that we could see. Then what you want to look is the IT general. When you're looking at the IT general, there's two aspects of it. Controls over program changes to software. So let's say that you have like a QuickBooks versus an internally made program. Well, QuickBooks you can't really modify because like it's the software itself. But the other one, since it's like a one that the company makes in-house, there's a lot of things that they can modify. And the number two is the logical access. So who can use it? If it's only like, let's say the CEO, well, you have a lot less risk if it's him rather than like all the employees in the firm. Another way to do it, to look at internal control system, is narrative. So pretend you're a storyteller and you walk through the life of a particular item from the beginning to the end. So that's a big like walkthrough, except you're really giving like a story of like all the internal controls, but not just like one single like procedure. Flowchart, you could like draw it. And ICQ, it's like a bunch of questions that might help you assess if there's like a red flag. So let's say like in terms of super users, can everyone access, let's say, this computer 24/24? And if the answer is like yes, maybe that's something you have to look at. Maybe that's something that you'd be like, okay, well, since everyone has access to it, like, why would I use it as, my control as the auditor? There could be a lot of things that could be modified by them, so I'm not going to be using it. Okay. Now we're going to be looking at a system of internal controls, and these are the things in the system of internal controls that you'll be looking at. Strength versus weakness, and this is more for your midterm, but like let's say a system is there's something good about it, you mention it, but if there's a weakness, you also have to mention it, because at the end we'll see that all the weakness, you'll take them together and it'll be important for the management. And also you want to take weakness and then you want to transform them into strength. So that's why you really have to look at all the weakness and identify them. Okay, so implementation and competence. After determining if a procedure is preventing or detecting, observe if controls have been implemented, if it exists or not. And not only if it exists or not, but you have to make sure that the people that are dealing with it are competent. Then control might work in theory, but does not mean operating effectively. And I could tell you, like in my work, when we're like talking with a client, and then I remember last week he was talking about this guy was selling his company, and the person that was doing the bookkeeper was like was his secretary, and so he spent like my manager spent 15 minutes asking about the credentials of the person doing the secretary, for the bookkeeping, because it could be something that, even if you tell them, do this, do that, do that, you have to make sure that the person is competent, or it could be very pervasive, where it could impact a lot of accounts. Okay, and then evaluating absent, not working effectively in internal controls. So then there's 3 levels of deficiencies that you could have. First one is control deficiencies, something not properly designed or not operating effectively. So this is not too much of a major problem. It could be just like, let's say this person is not authorized to the warehouse. Well, in that case, you just make sure that he doesn't have access to it. Significant deficiencies, less severe than material weakness, but still important to merit the attention. So you could bring this forward, any significant control, to the governments, and we'll see that in the letters after. And then finally have a material weakness. This is the red alert. Like, this is really important. And if you want to like categorize the 3, this is my 2x2 diagram. So you will look at the likelihood and the dollar amount. So if both of them, the likelihood and the dollar amount, is low, then you have a CD, control deficiencies. If the likelihood is high, but then dollar amount is low, you have SD. Same thing, high dollar amount, low likelihood, SD. And then you have the material weakness, which is if the likelihood is elevated and dollar amount is elevated as well. And if there's any deficiencies, don't be like, okay, there's a weakness there, bang, that's it. No, you have to make sure that they could be a mitigating control. And let's say you're a small company. Did I put here? See? Okay, I'll just say. So imagine you're this small company, and this person has no segregation of duties. So they're doing the bookkeeping and they're doing the cash, right? So that's a weakness, right? But you want to be looking at if there's a compensating or mitigating control. So what could be an example of a compensating or mitigating control for that? So the person does the book entry for the cash and does the cash deposits at the bank. What could be one compensating or mitigating control for it? Well, do you guys see the problem at first? Someone try it? Any compensating or mitigating control? You guys understand the question? Let me ask Patrick. Patrick, are you there?
Yeah, could you just repeat it?
Yeah, okay. So what you want to be looking is that if there's a weakness, there's a compensating or mitigating control. So I tell you this, a weakness. The person that does the cash bookkeeping also does the cash deposit. So the problem here is that, let's say, oh, we're only depositing $1,000, but that person writes, we're depositing $900. And then it goes at the bank, deposits $900, and then, like keeps $100 for themselves. So that's a weakness. Could you tell me if there's a compensating or mitigating control that could happen in the company that would make this thing weakness into not a weakness anymore?
You could always bring someone else to make the deposits to make sure that they're actually putting the whole thing instead of just pocketing like the $100.
Exactly. So you would try, but in this case, this person does the same thing, right? Is there something? Yeah, Elizabeth, you want to try?
I was thinking that in any well, I'm assuming in this case it would be like a sales receipt, that all sales had to be put in with like an invoice or receipt attached to show that it was in fact $1,000 and that it wouldn't be possible to deposit 900 when in fact it says 1,000 from your client.
Yeah. So you're saying that basically you need additional documentation, right?
Right, like a third piece of
Okay.
documentation. Yeah.
Exactly. So those are the things that you could consider, and still, if someone else could also check the amount prior to the deposit. Yeah. So you could have, let's say the CEO sign off every time, double checking this person's work. So that's a weakness that, is actually not a weakness because there's other measures to it. So always look at if there's a compensating or mitigating control. Effectiveness of client's control system is the design control effective and is the control operating effectively. So these are the two things. And the reason why you want to see if, you know, if the design is weak and the control risk is at the max, then, you know, your detection risk is low, so you have to do a lot of work. So always make sure that you want to test the control risk first, and if, you know, it's fine, then you have a lot less work to do. That's the big emphasis here. Now we're going to be looking at the outsourced systems. Type 1 is just, is it working effectively or not? And then type 2 is it working effectively or not? And sorry, is sorry. Type 1 is the system design well. Type 2 is the system design well, and is it working effectively? So if I do have an outsourced system, what I want is type 2. I don't want type 1, because type 1 only tells me if it's designed effectively or not. I want to make sure that it's both. And even if they give you a type 2, you can't be saying, oh, well, if it's type 2, it's fine. There's two things that you have to look out if it's type 2 report. Number one is relying on specific types of control that might not be on the scope of type 2 report. So let's say your outsourced system. Actually, guys, do you know what's an outsource, like what's the biggest outsourced system out there that companies have? Just want to make it like, so you, like, if you do see this in your exam, like it'll give you like a hint, like what kind of outsourced? Yes, payroll, exactly. So you have like these big companies like Ceridian, ADP, they just do this. But if you're doing an audit and the company has, you know, ADP as their system, sometimes they're also audited, right? Most of the time, either type 1 or type 2, and you would prefer a type 2. But there's two things you have to check. Number one is, you know, is the scope there? So let's say the type 2 reports that I got, it's not even on payroll. It's on, let's say, IT functioning. Well, I can't use it. I need something for payroll. Number two, is the year end the same? So in the next slide, this is the graph. So let's say the client is here, and then they have the year end here. So you're gonna be auditing this whole thing here. But then ADP issues the report on 0630, a type 2 report. Okay. Well, if the issue here, that means that they did all the work beforehand and it's good. But here, you're not sure. You don't know if the type 2 report is good, because there could be like, you know, 6 months, that's a lot. Let's say it's like 2 weeks, it's not that bad. But like if it's 6 months, well, you have to make sure that you have another report covering this part here. Okay, all good, guys? Correct. Control risk matrix. I don't think you're gonna be tested on that. Just put there, but it's just you're matching the control risk with the internal controls and the weakness. That's pretty much it. You just want to see like where there could be problems in your map criteria, but like honestly, guys, I've never seen this on the exam. Just understand it quick, and that's move on. Okay, so risk of material and the audit approach. Auditors have few methodologies to identify the risks of material at the assertion levels. Okay, test of control, substantive approach, and combined approach. So these, yeah. Okay, so I put here the overall audit approach, either substantive or combined approach. So if we, regardless of the overall audit approach, can I just use the test of controls? Can I just take the test of controls for like a part of my audit or not? Or I can't? No? Elizabeth says no. Why do you think that is, a little bit?
Because you have to do more like substantive testing. You have to go into more depth. There's materiality for different types of accounts.
Okay.
There's no perfect company that has great controls.
Exactly, but what if I can't use substantive approach? What if the machine that I'm trying to audit, it's just everything's like automatize, yeah, automatize, yeah. I can't use
Automated.
automated, yeah,
Automated. Yes.
exactly. So can I just use test of controls for that machine? Because I can't substantive, right?
Okay, just for that machine. Sorry, I thought it was
Just-
for the whole audit. In general, we can't just rely on the whole test of the controls. But I guess yes, dependent on, you know, its materiality and whatever resources you have available.
Yeah, so that's, I'm trying to trap you here, but you did a good answer answering me. So exactly, there's two things. There's the overall audit approach. So you're looking at the company itself. How am I going to go? Is it by substantive or combined approach? And like within one account, so let's say this accounts receivable, it's only like, it's very whatever, yeah, the word Elizabeth said.
Automated.
Automated, Jesus.
Automated.
My French is coming out of me for tonight. I don't know why, but yeah, automated. So then you could use the test of controls, but overall audit, you can't say that you're going to be using the test of controls. It has to be either substantive or combined approach. Okay, so test of control only. Yeah, here have a highly automated, high volume type system. Would be quite difficult to just do substantive because there's just so many there's just so many IT stuff that could happen, and you don't have time to test one by one. And the thing about this is that there's a greater risk of someone altering the info and not being detected, because when you're talking about something that's automated, it's preventive, but it's not detective. So like, let's say preventive, like let's say a system that sends out emails to people that have mortgages of less than $500,000. It's preventive, so it'll make sure, but like detective, like let's say there's a mistake, there's nothing to catch that error. So that's the detective part of it. Then the substantive approach does not mean controls are bad or weak in effect. It just means the author just decides not to rely on internal controls if the internal controls are not designed effectively. Yeah, so if the controls, you assess them that they're not usable because let's say management integrity is bad, then you have to go full substantive, and this is what you don't want to do because it'll take a lot of time and error. So I remember, I think during my final exam, one of the question was like, if you do combined approach, it'll take you like 17 hours. But if you do test of controls, it'll take you like 50 hours. Well, in that case, it would take combined because it's less work. Even if, yeah, you technically did substantive, but the substantive takes less work than actually doing test of controls. And let's say you have 10 invoices worth $10 billion each. Well, you'd rather just do substantive at that point than looking at all these controls. You look at the 10 checks and you're done. So combined approach, rely upon controls and collect audit evidence through a combination of controls, so substantive and test of controls. There you go. So this is just a little tip of the book. So obtain and document understanding of relevant internal controls, evaluate design effectiveness. So if the controls are effective, yes, you do a combined approach. If no, then you only use the substantive approach. Then here you go down. Are they designed and perform tests of controls? They're good. Continue. Evaluate result of test controls. You continue. If it's bad, then you drop to substantive approach on the other side. And that's how you would assess it if you're doing combined or you're doing only substantive. Okay, so test of controls, procedures to test the effectiveness of controls. So here are the test of controls. What are the actual audit procedures that were performed to support the assessment that internal controls are designed or operating effectively? I put stars here because like I want you guys to remember this for your midterm, right? Make inquiries, inspect documents, observe control related activities, We perform client procedures using our software and data analytics. So remember this for your midterm. Okay, so audit software and data analytics. You have ACL, IDEA, which are like Excel and storage. Don't need know more than that. Test data approach. This is like if you want like to trap the system, see if it's working adequately or not. This is how you would do it with a test data approach. And if there's a change in IT system, you have to do a conversion audit, and you have to evaluate the both system done midway through the year. You want to look at the controls of the old system and the new system, and see if, you know, let's say the two balance of the conversion is the same, or is there like a discrepancy between both. Okay, and this is important, guys. Put a star on this. I'll come back for your final as well. So all the little mistakes that you found, you accumulate for the end of the year. Then there's the internal control letter, and this you're communicating to who? The audit committee. Remember that internal control letter. That's the audit committee, right? You're talking internally to the team, to the audit committee, because they're your boss. Okay, so this is like everything that's big that's going on, then you report to them. Otherwise, you talk to management, and these are more like suggestion on how you want to change the controls, or if there's any control weakness, and if management wants to like change a little bit of something. But what's important here is internal control letter, and if something is bad, you got to give it to the audit committee. All right. That's it. So we'll take a little break now, and we'll do the exercises. We'll come back at 8:15. Okay. Okay, we're back. Is everyone there? You good to go? Okay, perfect. Did you guys do this problem here? Gold Explorer one in class? Yes, no? Yes, okay. Okay, maybe we won't do it. We'll do the other one here, Ali Gold Mining. And if we have time, I'll come back and do it. The other one. So I want you guys okay. I want you guys to help me out with this. Okay, so I'll read it. Okay, Ali-C is the gold mining company which trades on 3 public exchanges. Ali-Co has been operating for 10 years now. Their main activity is mining to extract gold. The company has been operating for 15 years. Profit for 2021 amounts to $13.5 million. However, Ali-Co had a big write-down of 1.1 billion due to some extraordinary circumstances which brought down the company to a net loss of $944 million in 2021. However, Ali revenue has been experienced a 20% growth in the past 5 years, while profits experienced a 2% growth per year. Ali has the following elements in their balance sheet in the year end December 31: assets 1.5 mil, AR 750K, PPE 2 mil, liabilities 900K, AP 500K. I've been doing audit Ali for the past 2 years and enjoying this client. No material misstatements were found in the past engagement, and management has always been helpful during your audit procedures, providing you the resources needed. During the year, Alico acquired Gold Inc. in order to expand their operations in Europe. They were confident this will allow them to attract more foreign investors. Okay, so what I'll do is I'll give you like the formatting, and I want you guys to tell me like for each case. Okay, so we'll start always with the users of the financial. Can you guys see well on the screen? Yeah? Yes, no? You want me to zoom in? It's well, okay, I'll zoom in. I'll zoom in. Jeez. Which one is here it is. The picture is so huge, that's why. Okay, so users of the financial statement. Who is it?
The public?
The public. So who's a public slash right investors, or you could even put like shareholders. Yes, shareholders. And what about this public company? Is it big or small?
Pretty big.
Pretty big. So if it's big, that means there's many users, right? Users. It trades on 3 stock exchanges. Okay. So I'll ask you guys this. What do investors care about? Right. So this is what will determine your quantitative, like, are you taking, let's say, EBIT, earnings before income tax, are you taking revenues? Also, in this case, what do investors care about in a company that's trading on the stock market? Earnings, yeah. So profit, yeah. So profitability. The impact EPS. So care about net income. Okay. So what kind of measures that you guys see here in the problem? The quantitative.
You have the profit and the loss.
Okay, perfect. So we'll start profits / loss. So we'll do this as our number one. So what about the profits and loss, Patrick?
Well, first they showed a $13.5 million profit before write down.
Yeah.
And then at the write down there was a loss of $944 million.
Yeah. 0.5 millions of dollars. But there was a write down of 1.1 billion, right? Right now. So no, the net loss is 944 million, but the profit for 2021 amounts to 13.5 million dollars. So you see, there's a big like gap. There's a shift. There's a big write down of. So that brings it to a negative 944 billion. So here in this case, we talked a lot about like profitability. We care about net income, but here, right, materiality. Do we want something that changes a lot from one year to the other, or no? No, right? Okay. So what's another measure, guys? That you guys see here?
Total assets.
Yes. So what about total assets, Patrick?
Well, they have a $1.5 million in assets plus 750,000 in accounts receivable and 2 million in PPE.
Okay. And does it mention anything from beforehand, from the other years, or no?
No.
No, exactly. So like, I'm gonna take this here. I'm gonna snip it. Right? If you want the materiality, is that you want something that's consistent from year to year. If they don't even give it to you, right? Can't really do much about it. And even that, you're looking at a company, a mining company, and what's the user's needs? Is the company profitable or not? Do they make money? That's what they want to know. But here is just asset. It's not because you're growing assets. That means that your business is doing automatically better. So what else is there? Is there something else? What about revenue, guys? What about revenue?
Just gives us a percentage.
Yeah. So a percentage is based on what? Based
On
on
the both year, current and past year.
exactly. So how much is the growth here?
3%.
How much
3%.
for revenue?
Been experiencing 20% from past 5 years. Well, oh no, yeah, revenue 20%. Yeah.
Okay. So here even it says 20% growth in the past 5 years, right? So we're not taking from last year, but we're taking five years. Okay. Oops, can't write. Okay, what else is there? Is there anything else? Because remember, there's revenue, right? Then there's like cost of goods sold. Then there's your gross profit here, right? So XX here, XX here. There's this here, your gross profit here. Then all your expenses here. And then this is like your included is like your tax. And then here you have your net income. So what else could we take? That's from 820. Is there something else we could take, guys, here? About this? Right,
You also
so
have the gross profit
exactly.
increase.
Yeah. So because of the write down, we're at negative 944 million, right? Okay. But here we still have a profit of 13.5 million, which is the gross profit. Right? And there hasn't been a big write down because here the write down happens where? At the expense level. Could be like loss on impairment, and that will be reflected in your P&L like this in your expenses. So here, does your gross profit, is it impacted or not by the big adjustment, the big write down? Does it? Right? No, exactly, it doesn't. So that's why you want to take something that looks at profitability, but at the same time has not a big gap from last year to this year. So this is how you have to be assessing like which measure you want to be taking. And the number one thing that, like, let's say I remember from last semester, people like, yo, this case was crazy. It was so hard. Like, I did not know what to choose. You look at here, like, you'll see this in CPA school. What's the bias? Okay, the bias is like, in this case, when you're reporting the financial statements, the one that's doing it, so like management, what are they biased on doing? So in this case, is that they want to have income overvalue. Sorry, they want like profit overvalued or undervalued. They want high profit or low profit on their financial statements. Overvalue, right? Profit overvalued, so they could satisfy. So they have like high EPS, and then they have like high, uh, uh, they do well on the stock market, high stock price. So that's why you would take the bias and be like, okay, well, if this is what they want to do, well, I'm going to be taking the gross profit. Let's say it's a tech company, right? The tech company, they want, tech company does not do profit. So they just want to have 40% increase in sales. So the bias is that companies in tech, they want like not only 30%, but like 40% increase in revenue. So that's why you would want to take revenue as a measure. Okay. So now we're going to look at the quantitative. So what are the factors that would suggest lower materiality? So then you would go to like here, then you would take this. So for your exam, memorize this. 1 + 1 = 2. 2 + 1 = 4. 4 + 1 = 6. 6 + 1 = 8. 8 + 1 = 12. 12 + 1 = 16. 16 + 1 = 18. 18 + 1 = 20. 20 + 1 = 21. 21 + 1 = 22. 22 + 1 = 23. 23 + 1 = 24. 24 + 1 = 26. 26 + 1 = 28. 28 + 1 = 29. 29 + 1 = 30. 30 + 1 = 40. 40 + 1 = 50. 50 + 1 = 60. 60 + 1 = 70. 70 + 1 = 80. 80 + 1 = 120. 120 + 1 = 200. 200 + 1 = 400. 400 + 1 = 600. 600 + 1 = 800. 800 + 1 = 900. 900 + 1 = 1,000. 1,000 + 1 = 1,000. Okay, very important. If you don't know these factors, you're in trouble. Okay, so fraud risk. Is there anything here? Well, Cleveland, I'm doing like a quiz 2 review because technically anything here could be like, it won't be testing as a long question, but like key components of this could be tested in your quiz. It's just that it's very cumulative. Everything's cumulative. But like I still have to do this because it is technically on your quiz, all the material. So like if you understand this, you should do fine for your quiz. And your quiz is like 5%. Like it's meaningless. Before it was like 15%. So now you're kind of doing midterm and the quiz. And for the other midterm review, it will be a lot more exercises, which is more cumulative. Does that answer your question, Cleveland? Yes, no? Yes, perfect. No, you no problem, homie. Okay. So does it mention any fraud risk here? No. Or is there a fraud risk possible?
Is it possible that they could have either overvalued the write down so that they have the loss and carry it forward
Yeah, but
to
like,
avoid taxes?
but
Or that's
usually
just
like,
too.
yeah, that's so usually you would take more like case stuff, but like you got some good auditing thinking. But it's a bit deep, right? It's a bit deep, just like at the surface, like how can a gold company like have fraud?
The employees could just steal the gold they mine,
Yeah,
possibly.
so fraud risk. Well, gold is expensive, so high risk of theft, right? And also, like Elizabeth said, the write down it is pretty good. So if I could think of it, is um, it's more about uh the depreciation because the way you could look at it is that they want to pay less tax at the end of the year, so they want to book more depreciation. And here you have a lot of PPE, means that equals depreciation. Okay, but usually you would stick with cases in the fact in the here. Okay, usually take like just that here there's not a lot of information, but usually you just take information from the case. But since here it's like a gold company, a lot of mining equipment, so you have a lot of depreciation. So they might want to uh, let's say have bias estimates. So this is a negative. So this is what will bring down your materiality. Is there anything about non-compliance with law? This is mentioned something about it.
Not really.
Is there something positive about it that they did well? How about this, Patrick? No material misstatement were found in the past engagements.
Yeah, that would be for point 3.
Oh yeah, that's true. Misstatement in the past, yeah. So non-compliance, you're very right. There's not that much. But the fact that yeah, I guess so. No material misstatement. Yeah, I would put it more there. You're right. No. Yeah. No. This. Okay. How about significant related party transactions? Do we have something there? Do we have something there? Is there a
Would it
big
not be the
transaction?
right? Would it not be
Sorry.
the write-off? I mean, it's not a transaction, but the write-off would be considered, or the write down?
That would not be like related. Like, let's say there was a write down because of a merger, then that would be significant related party transaction. But in this case, it's just the impairment, right? If
Okay, makes
let's
sense.
actually double check, big write down of one due to some extraordinary streams. Yeah, so it doesn't mention. So here it's really just like M&A activities.
Would the expansion and the acquisition of a Gold Co be a significant part of your transaction?
Yes, but when you're doing an audit, are you looking in the future or in the past in the financial statements?
Past.
Past. So in this case,
Yeah, it's in the past.
well, did
Oh,
they do a transaction in the past?
but it just said during the year.
Yeah, so here acquired Gold Inc. in order to expand their operation in Europe. So did they acquired, so did they expand? Yeah.
Yeah.
Yeah. So let's say Elizabeth, they mentioned here the write down was because of the acquisition of Gold Inc. Then it would be like a write down or of significant because of that. But here you could
Okay,
just write
got it.
you could just write acquired Gold Inc. Gold Inc. So that's a red or a green? Red. Was there a change in the accounting method?
No, haven't they always been public? So it would always be IFRS for the last 15 years?
Yeah, yeah. Exactly. So if, like, let's say they acquired the company, they went from ASPE to IFRS, then that would be a different, a big difference. Was there a major change in operation? How about the M&A here? I think we could put it right. Acquired Gold Inc. Significant change in business. That's a red. So difficulties in internal controls, does it mention anything?
No.
No. So nothing. Put nothing. Nature of the business.
It's gold. It's pretty stable and boring. I'd say it's
Could
not a
say that.
particularly risky commodity.
Yeah, but at the same time, like, since gold it's the, like we were talking about jewelry, right? Before, it's an asset that like is inherently, like, it could be people stealing. So like, you get what I'm saying, Elizabeth?
Oh, so you're saying that it's the opposite, that it is indeed risky. So maybe, and
Yeah,
it's not always very easy to evaluate. You probably need like external people to come in.
exactly. So I don't know if you heard, but like, a bunch of like companies on the stock market, um, gold mining companies, like, so like, oh, we got this gold like depository in like Thailand, and like it ended up like never, like, it was fake or something like that.
Ah, okay.
So they even have a movie with the what's his name, Matthew McConaughey, about that.
Right.
So
Fool's gold. Yes.
yeah,
Okay,
something
that
like
makes
that.
sense. That makes sense. Okay.
So you could say like niche of business, so like
Eh,
high risk.
Could we have also said that, like, oftentimes that mining and those type of business have always like even profitable, but always have some type of going concern.
Yeah.
Like
So
they don't find gold, that therefore they wouldn't be profitable and run out of business.
exactly. So you can see that mining businesses, like, they're very like capital intensive. And what's the bias here is that they want to have gold. So they're very pressured to say like, oh, look, we actually have gold, or they're gonna go bankrupt, right? So, but like, I kind of sauce it a lot, but like, guys, don't sauce it too much. Like, be sure that you're taking stuff from the case. So I'll just put like high risk because it's high commodity. the best thing that you could do, which I'm not actually doing right now, is I just want to go like give you a sense of like the thinking behind it. But just take in your exam, you take parts of like, let's say no material mistake, you take that and then you copy paste right in the part that you have. Okay. I'm just doing this because like in this case, there's not that too much information, but like in the midterm, you have like a big case that you'll have a lot of information to work with. So then here, is it a new client or no?
No.
No, perfect. So it's, they said what, 3
3 years.
3 years, right? Like that. And it's right. So public company, it's traded stock market. So it's traded on the stock. So look, how many do we have? So we have 1 here, 1 here. So let's say like this will lower our materiality, this will increase. Okay, so we have 1 here, have 1 here, 1 here, 1 here, 1 here. Okay. Oops. Sorry, sliding. Where is it going? Okay. Like that. Like that. And then what's the total? The total is 8 plus 2. So here, let's say we take gross profit as our measure of 13.5 million. So we can see gross profit is 0.525%. Oops. So gross profit. So it's 0.5% to 5%. Okay, so what do I do here now, guys? I have 6 factors that will lower my materiality. And then here increases, there's 2. So what should I do, guys? I want to find at the detective risk, my materiality. How can I come up with the final number, knowing that this is 13.5 million? Any suggestion, guys? Because I want to get a number of materiality. Yeah, Patrick, go ahead.
Well, we know we're gonna be under the half, under like we're gonna be on the lower end of the scale. So do we have more lowering factors and factors that are going up? And then we could just approximately ballpark like a 1% or 1.5% of the gross profit.
Okay, perfect. So we ballpark it between 0.5 and 5%, but like which number would you choose, Patrick?
You're like 1.25% since we have more lowering factors than increasing factors. Even though we still have a little bit of increasing factors, we won't put it at the end of the scale.
Okay, and how did you come up with 1.25%?
Because I looked at the fact that we have more lowering factors. We have 6 versus 2 increasing factors
Yeah.
of materiality. So I know we shouldn't put it directly at 0.5% of the gross profit, but we should be a little closer to the 0.5% than to the 5%. That was my thinking.
Okay, so did you actually do a quantitative or you just like did like an estimation about that?
Yeah, more estimation.
Okay, so that's good. But I think what you could do also is like you take 0.05, then you minus 0.005. So that's the difference, right? In percentage. And then you take that and then you divide it by this. Okay. So that means that for like, let's say each green stuff, it will make your materiality go higher. You're going to increase it by that amount. So let's say we start at 0.5 because we can't go lower than that. point, let's see how much you get and I get. So, oops, that's 5%, which is 0.005. Then let me put some decimals. That's too low, sorry. What is it? 0.5%, 0.5. Let me take out the decimals. Right, and then since we got 2 green, we're gonna do this times 2. So in terms of percentage, this is that. So let's add both. So it's 1.625%. Patrick, you got what? 1.25, I think. 1.25 is always.
Yeah, that's what I ballparked it at.
Okay, so that's a good estimation. It's just that this is like more like you have like a more general thought behind it, and then you take this amount and then you multiply it by the 13.5 million. Bang. That's your materiality. Right, $0.2 million. Okay. Any questions? Yes, Elizabeth?
Okay, so in this case, the materiality is going to be $200,000 for overall, correct? Overall materiality?
Yeah.
Okay. And so my question is, why did you add the 6 and 2 to give you 8 if we know that technically the 2 is going to be increasing materiality? Like, wouldn't it be 4? To me,
You
it would be
mean
4 because you would add them together. Like the 6 and the 2.
yeah.
Or do you
Like,
just added it to 8 to just because it's total sort of points that you have to?
yeah. So wait, so why did you say 4? Like you did 6 minus 2?
Correct. Yeah, because I
Okay.
figured that 4 would be
Okay.
the threshold that represents having to lower
Okay. I see.
materiality because there's more cases of things being more risky, so you need a
Okay.
lower materiality threshold.
Okay. So think of it this way. I'll try to visualize. So imagine this is the line for 0.5%.
Okay.
Okay. And imagine this is the, what is it? The 5%.
Mhm.
So 0.05%. And we want a number between this, right?
Mhm.
But then we have 6 things that will make our, if you think about it, like we got to put the 6 and the 2 somehow, because these are what are standing between the 0.5 and the 5%. So let's say we take
Okay.
2 green here. Okay, so I'm gonna try to put this in color. Give me a color, line color, like that, and then the rest is like that. So in total, the whole thing here is 8. But here you
Okay.
have 2 that's green, so that's what's increasing it. And this is what's like lowering it. So this is the spot that we want, which is the 1.63%. So you're saying like, okay, each number here, so you have 1, 2, and here you have like, let's say 8.
Okay.
How much does that represent in this scale? And since we're going 1, 2, right?
Mhm.
Here,
Yeah.
you have 1.63%, but you could do the same thing on the other side, where you be, okay, let me start with the 5% here, and then we'll go down 6 times the red. But at the end of the day, you have the same answer. So that's just the way that I visualize it.
Okay. And so then can you just repeat how you got the 1.63 from, so now I understand we have the 8, which is our full sort of maximum amount for materiality or
Yeah,
in on that timeline. Yeah.
so the 8 is just how I'm dividing the 5.5, the 5% minus the 0.05, so that's 4.5%. which is
Right, yeah.
this. And for each bounce I'm doing here, it's 0.6, 0.6. So 0.6, 0.6.
Okay.
And since here we're at 0.5, and then you're adding it with 0.6, 0.6, then you're at 1.63. Right, so this is there. Right here, like in the middle here, like let's say I merge these two. Yeah, 1.63.
Okay.
Does that make sense?
I'm
Or
not
you're not too sure?
100% sure, but I'm just gonna let it marinate in my brain.
Okay,
It'll be okay.
If anything, after the tutorial, I'll just try to go over with you and see if anything's missing.
It's all good.
Right?
Thanks so much.
Perfect.
Yeah.
Anyone has other questions? Okay. Okay, I'll also put a solution, but it could change a little bit the solution. But this is just like the overall idea I want you to have. So have a template for the midterm, and like honestly, like in the quiz, like the reason why I'm doing this is because like they could be like, okay, so what's a risk that would lower is nature of business uh something that could increase or lower materiality. So that's why like anything is fair game at this point for the quiz. Okay, so now let's move on to the other exercises. Let's see. So it will be chapter 9. We'll do chapter 9, guys. Okay, we have a lot of time. How was everyone's week? There's a lot of midterms going on?
Yeah.
You still surviving there, Patrick?
Oh, it's Saturday and Sunday.
Last Saturday and Sunday?
No, this one.
This one, okay. Okay, so then you have on top of that, you have a quiz for 360, huh?
Yeah, a quiz for 225, an exam for 225,
Okay,
exam for 420,
okay.
and
And
this.
is your other exam on? Okay, so this is your only accounting exam?
No, Acco 420.
Oh, 420. Oh, okay. Yeah, 420 is not the easiest. And there's no tutors for that right now. Yeah. Okay. Yeah. Okay. So did you guys do this in class? Okay, then we'll review it. No? Okay, perfect. So each situation present a control and a way to test the control, evaluate the efficiency of the test of the control. So basically what we're trying to see here is that if the control in place by management, does it test what we want, or is it just a test control that's kind of irrelevant at this point? So prior to the self-staff processing in order, the customer's credit must be reviewed by a supervisor who completes and signs a customer credit review form. Test of control, select a sample of the sales order and review payment supporting documents to determine if the customer ended up paying for the order. So is the control, are we testing the right control or not?
No.
How come, Elizabeth?
Because their payment is not proof that they have good credit. Like you should
Exactly.
be checking out the customer credit forms, not the actual sales invoices.
But here, so you said you should be checking what exactly?
Because it says the customer's credit must be reviewed by the supervisor who
Yeah.
completes and signs the customer credit review form.
Yeah.
So you'd have to go and check those ones and make sure that the supervisor actually did the credit review versus seeing if any sales or payments were made. It's the wrong
Exactly.
supporting documents.
Amazing. So it's not because someone did pay, it means that the manager signed and completed the form. So in this case, its procedure is good, but it does not review customer's credit. So we would credit. A sample from invoices and checked signed. Okay. How about the other one? At the end of each month, the accounts receivable AR supervisor prepares the age AR list. The list is reviewed by the AR manager who must sign it off. Inquiries of AR supervisor how the AR list is used to calculate the AFDA. Are we testing the right control here?
Yeah.
Okay, so
believe so.
what's the control here, Patrick?
They're trying to see how what they're doing is getting the approval of the AR manager and so that they could for the aged accounts receivable.
Okay, but here, what's the most important part of this?
Must sign off.
Who must sign up? Is it sign off here? Are we testing that?
Oh no,
No,
we're just looking how they do it.
exactly. So we're testing like the accuracy, but like we're not testing like the existence of actually of it being signed off. Okay, so like Patrick said, procedure is good since you want to inquire who's the guy manage this the supervisor how AFDA was calculated. However, not trying to do this. We want to check the sign off. Okay, that's the most important thing. How about the next one? At the end of each day, warehouse staff submit all unfulfilled customer orders to their supervisor. Only the supervisor is authorized to cancel unfulfilled customer orders in the company's financial system. Test of control requests warehouse staff to log into the financial system and attempt to cancel an unfulfilled customer order. Is this good or bad? Are we testing the right control?
Yes,
Yes. Why would you think that, Maria?
because if one of the warehouse staff tries to do what the supervisor is supposed to do, it's not gonna work.
Exactly. You're trying to kind of like trap the machine by saying like, look, okay, if it's not the supervisor that has access to it, it's gonna be someone else. Wait, guys, give me 2 seconds. Sorry about that. Sorry about that. Yeah. So you're trying to trap the system by saying like, okay, I'll give you a fake one to see if it's gonna work or not. So that's right here. Good procedure to control. Okay, how about the next one? Employee responsible for shipping are separate from the employees responsible for accepting and processing the sales order. Steps to control: obtain HR files of employee who work in the shipping department and review whether they ever work in the sales orders department. Review whether employees working in the sales order department ever work in the shipping department. Is this control good for the? Is this test of control good for the control? No, perfect. Lee, do you want to tell us why? Or you do not? Either way. Okay. So I guess I'll answer for you. So yeah, so here you're basically just checking if that person works in the other department or not. But is it actually what you're looking for? No. You rather do like beforehand, you actually physically test if they have access or not. Because it's not because if someone work in the other department, it means that you know, if they haven't worked in the other department that they're free of anything. They could have access potentially, but you never know. So here we just say like, no, would want to test the like previous. No problem, Lee. Previous. Okay, so the quantities on the order delivery note are checked by the warehouse manager against the actual quantities prior to shipment. The manager stamps good to go on the delivery note for each checked order. For example, orders that were shipped, obtain delivery notes and check if they were stamped. Is it good or not? Yes. So Elizabeth says yes. So yeah, you're basically just testing for existence on for the stamp. So So now we're going to do question 926. Okay, based upon the case facts, indicate whether the type of control risk is pervasive or risk at the assertion level and the impact on the control risk, whether it factor increases or decreases the control risk. Okay, there have been a number of discrepancies in the company's cash balance. One of the managers suspects that Dominic, CFO's cousin, may be removing cash on Friday afternoon. The manager, however, is afraid of getting in trouble with the CFO if she confronts Dominic about this issue. So guys, is this pervasive or is it at the assertion level?
Sorry, I have a
Pervasive.
question.
Oh, sorry, go ahead.
Sorry.
We'll go with Maria first. Go ahead.
Did we skip the one with the CFO?
Oh yeah, sorry. Yeah, good. Let's get that one. About that. Thank you. Elizabeth, was it the same thing?
Oh, no, I didn't notice that. It was to answer
Okay.
the question.
You were already answering. Okay, so yeah, we'll go through this again. Yeah, it's 9 p.m. guys, and I just worked the whole day, so like I'm a bit tired, but I'm happy that you guys are here and there's not like 3 people. That's true. So thank you for being there. Yeah, control all blank checks are stored and locked in a safe. Only the CFO and the finance manager know the code of the safe. Confirm with the CFO and the finance manager that they always keep the safe locked and that the code is safe containing at least 6 numbers. So Maria, I'll ask you this. Do you think this is a good test of control?
I'm not sure. I don't think so.
And why would you think no, it's not? What's like missing, would you say?
I don't know.
Okay, so let's like décortiquer this. I don't know how to say in English. So yeah, all blank checks are stored and locked in a safe. Did it mention anything about the checks actually being there in our controls? No. So what we want to do is like maybe just have like an inventory count. So go there and see if the checks are actually there. And also the second thing is only that the CFO and finance manager know the code to the safe, right? So what do you guys propose for this to test this?
So we just test if people actually knew the code. So like if for example, you take like 10 people that are not associated with it, see if they could write in the code, if they know the code, and if they don't, it might not be the best, but at least to control.
Okay, good. But Patrick, let's see, like I'm one of the employees, I'm not supposed to have access to the code, but I do know the code. But then
Yeah,
you make
I said it's not the best one, but it's one.
Yeah, so what's important here is that you understand the issue. The solution is going to be hard, right? But in this case, what you could do is just ask the CEO if, like, let's say, uh, does anyone have access to the code? If they tell you no, then yeah, so inquire, ask them question if they know the code, and let's say they tell you no, they don't. Only they can have access to it, but let's say another person have access to it, well, it's their fault, right? It's not your fault as an auditor. But like if you if you test the other people and they're not able to do it, but they know it, then you're kind of in the hot waters if they actually can access it by they have access to it. So good, Patrick, for identification of problem. Solution, we could work on it, but again, here's the difficult one. So let's say first would be like check if there is actually some checks. And 2, inquire management about inquire management about who knows the code. Okay. All right. So we'll go to the next question. Holy crap. Okay, we'll just not do question 4 here. Still have 15 minutes. Okay, we have a lot of time. Yeah. So Elizabeth, we'll go back to you for this question right here.
Yeah.
So is it?
I was gonna say it's a pervasive issue
Mhm.
because if they're afraid of, or if she's afraid to confront Dominic on this issue, might mean that there's like a hostile work environment, or tone at the top is different. People don't mind cutting corners, or just because people are family, they have different sets of rules or standards.
Mhm. That's very good. So that's a very good answer. And what I would say for like midterms, always use the keywords that they like. So what's the keyword would you use? Like start your sentence. Well, first of all, we'll say pervasive.
Um,
Because like when we have like problems like this in exam, like graders,
right.
they have like and they check if
A
you have to
grid.
say like the words.
Yeah.
So what's the word you would use here?
Well, it's. I would
You mentioned
assume. I mean, it's not discrepancies or being afraid of, like the fear. I don't know.
maybe it's too hard, like what I'm like, because right, I'll put this in bold. Tone at the top.
Okay, right. Sorry, tone at the top. Yes.
You're all good. So the tone at the top, what does it say about the tone at the top?
It says at the tone at the top that their employees aren't able to report potential fraud without repercussions.
Yeah, so we could say like, because one is, let's say it's bad. It's bad because CFO installs, I don't know if you could say this, but like fear for employee, right? So like, let's say he does that for cash account, like he could do that for sales accounts receivable. So that's why, since you're a CFO, you're touching many accounts. Tone at the top is bad. Most of the time, that tone at the top will be bad for everything else. So how about this control risk? Does it increase or lower control risk?
It increases control risk.
Increase. And you can even say for fraud as well. Yes. Okay. How about the other question? The company's controller is a very detailed and rule-oriented individual. Last month, she fired an employee from the accounting department who did not complete bank rec on time. The new head of purchasing has added 6 new vendors to the approved vendor list. No, that's another question. Yeah. So this one right here. What do you guys think?
I believe it'd be pervasive risk again.
Pervasive. And why, Patrick?
It's because of the capabilities of the accounting staff.
Okay.
That's now they're showing that the staff wasn't good enough, so that's why they fired the person.
Okay. And here we're talking about who's the person here that fired? She's
The controller.
exactly. Is the controller high ranked in the company?
Yeah,
Could we say that's tone at the top?
yeah, we can.
Yeah, I can put some more, but yeah, usually it's for the CFO, CEO, but even like here, controls like it's like the CFO's best friend. So you could say because tone at the top is like strict and enforcing policies. Because strict and enforcing policies, but control risk, will it go up or down?
And go down.
Exactly. Goes down. Okay. So like try to put some words, some keywords, right? Like that. My sentence doesn't make much sense, but like you're just hitting the key factor that a grader would want to look at. Okay, next one. The new head of purchasing has added new 6 vendors to the approved vendor list within the first 2 months of employment. Since the vendor offers products and services at much lower prices compared to other vendors, the CFO did not bother with the unusual new vendor verification process. So is that pervasive or is it assertion?
Be pervasive again.
Okay. And why would you say it's pervasive?
Because like again, the tone at the top is not very good since they just let everything pass without any verification.
Yeah, so we're very like loose. Yeah, there you go. And why are we loose is because like they want like discounts, right? want like discount. So like, okay, I'm gonna close my eyes there. But again, tone at the top. Right. So remember that before, like when I was talking about like inherent, like when you're doing your audit, like what's the big picture here? You have to look at the tone at the top. And if tone at the top is not good, what are you doubting? 2 words. 2 words. I want you to put this in your midterm.
Management integrity.
Yes. So lead, not control risk, but management integrity. That's like what we're looking for. That's when we're doubting the management. And if management integrity is bad, then we'll look at the control risk and trying to assess it. But sometimes if management integrity is so bad, you're not even going to be looking at the control risk. You're just going to be looking at substantive testing. So a number of warehouse staff called in sick one day, the annual inventory count. The warehouse manager could have postponed the count to another day, but decided to go ahead with the count and instructed her staff to only check initial count result. So is this pervasive or is it at the assertion level?
I would say pervasive again,
Okay, and why would you think it's pervasive, Maria?
because tone at the top is loose. Like they're not following the right procedures.
Yes, but usually tone at the top is like management, the controller, max. But here we're talking about the manager of like the inventory, right? So would you think it's like pervasive where it could touch many accounts, or is it just like the inventory?
Inventory in this case.
Inventory, exactly. So if it's inventory, we're talking about more the assertion level. Okay?
Yeah.
Assertion. So that's the difference between pervasive. It has to be someone higher ranked that could touch many accounts. If we were just talking about a manager that deals with inventory, then it's going to be only at the assertion level. And Maria, does this increase or lower, decrease control risk?
It will increase control risk.
Yes, so increase. So assertion level because only warehouse and increase control risk because test controls of inventory not good. Okay. To complete financial statements on time, the area manager worked all night to estimate the AFDA. The manager conducted a thorough review of each customer's credit balance. The balance estimate was thoroughly reviewed by the controller, who noticed and corrected a couple of minor errors. Okay, I'm gonna ask this question to Patrick, right? Because they were talking about controller, manager. So do you think it's pervasive or is it the assertion level?
It's going to be more assertion level since it's specific to the accounts receivable.
Okay. And Maria, do you agree with Patrick?
I'm not sure about this one.
Okay. So you see it, Patrick said that yeah, there's a controller, yeah, there's area manager, but what are we looking? We're looking at AFDA, which is only one account. So that's why it's at the assertion level. You get it, Maria?
Yeah,
Okay, perfect. Because only AFDA. And this will increase or decrease control risk, Patrick?
Still, well, give me a second. It'll decrease it, I believe.
Yes, sir. Right on the money. Decrease choice. Because remember I told you that there's always like strength and weakness. Well, let's say here the weakness is that I don't know, they work all night to do it, they're not sure, but the strength is that they actually have like a controller that's reviewing it. So always look if there's like a mitigating factor. Okay, over the past several years, the external audit of Nikola Inc., manufacturer of children toys, and its management letter expressed concerns about the company's weak internal controls. In response to address some external auditors' concern last year, Nikola established an internal audit department. So is this at the pervasive or at the assertion level, guys?
Can be pervasive.
Pervasive, right? Because it touches many accounts. And does this increase or decrease control risk, Patrick?
It'll decrease it.
Amazing. So pervasive. Because what is it? The internal audit, because the internal audit department touches like many accounts and decreases choice. Is there any question about this exercise? Okay. All right, last number before you guys can go to sleep or study for something else. All right. Let's get it. Let's get it. For this, did you guys do this in class or no?
We didn't do any exercise for chapter 9 in class the last time.
No.
No.
Okay.
For my section, but I don't know the other ones.
Okay. Perfect. Then we'll do it together. So here for each error, fraud, and other irregularity, identify one of the or more types of controls that were absent. For each error, fraud, and other irregularity, identify the objectives that have not been met. For each error, fraud, and the other damn this word, suggest a control to correct the deficiency. So I'll just do the first one, and you guys can do the other ones. Okay, so the incorrect price was used on sales invoice for billing shipments to customer because incorrect price was entered into a computer file. So here for A, what's the control that was missing? And it's in black. Right, it's adequate documents and recurring. Okay, B, what's the objective? Transactions are not being recorded at the correct amount. And C, what's the control that we could do to get this thing fixed? Well, you could, like, with the controller before and the manager, you would have periodic review by someone. Okay, is there any questions about this? So that's like the template. Perfect. So now I'm expecting you guys to help me with the other one. Okay. So a vendor's invoice was paid twice for the same shipment. The second payment arose because the vendor sent a duplicate copy of the original 2 weeks after the payment was due. So A, what's the type of control that was absent? I think here I could there's 3 seconds. Just find the so basically it's this. So this, okay, tax control. So like it would be like proper authorization, adequate documents and record, physical and logical control of our assets. So which one is it? A vendor's invoice was paid twice for the same shipment. The second payment arose because the vendor sent a duplicate copy of the original 2 weeks after the payment was due. So it means that you're paying the same invoice twice. So which one is it?
Proper authorization.
Okay. Yeah.
No, maybe more. Yeah, no, I'm not sure.
Because imagine like you have invoice 4011, right? And then you paid it twice. Maybe it's because you're not keeping track of something, right? The documents or the invoices that you're being paid. So it would be more adequate documents and records. Again. You get it, Patrick?
Yeah.
But again, like this answer is like, it's not clear as sky. It's very like, you can always see it in other perspectives, but like, let's say it's this. Okay. So what's the objective that have not been met? I think I'll just write it because like it's pretty hard. So it's just that you're having a duplicate invoice paid twice. So preventing receiving and paying invoice twice. I want you to focus on the last one, C. So how could I like make sure that I don't pay an invoice twice?
I think you can add like a control in your IT system to flag duplicate invoice numbers.
Yeah, so let's say you want to pay for an invoice like 4011, but let's say you input it and they tell you, you know what, you already paid for this, so it flags you right away. So like a preventive measure. So control entering same invoice. Okay. No, last one. Is it the last one? Yeah, last one. Employees in the receiving department sold some side of a beef. When a shipment of meat was received, the receiving department filled out a receiving report and forwarded to the accounting department for the amount of goods actually received. At that time, 2 sides of the beef were put in the employee's pickup truck after rather than in the storage freezer. So now you're just dealing with employees stealing beef on the job. So I'm gonna say Patrick, which one do you think it is of the controls here?
It's gonna be physical and logistical, logical control over assets and records.
Yes, sir. Amazing. Okay. So what's the problem here, Patrick? Tell me. What's the problem? Because we did have a control, but yet we're still having like people stealing beef.
More like the problem is supervision. They're just left to do whatever they want without any supervision, so they just take beef without any consequences because there's not a lot of supervision.
Exactly. So your control is that you want something that will preventing the stealing, right? There's nothing that makes it that they can't. There's like they just bring out the like how can you steal a freaking cow? You know, a cow from to the parking lot. So it's there's nothing preventing them. So what would be a measure? Who would you say that we
Well,
could
to
do?
prevent stealing, you could have security cameras first
Yes,
off
sir.
to prevent stealing.
And what about in stores? Like you have like what makes it that you can't just take an item and just go out with it?
There's just like the RFID chip or something that beeps or
Yeah,
activates when there's something that steals, or sensors. Yeah.
yeah, sensor when try you premises. Okay. Perfect. I think we're pretty much done. Is there any questions? Again, look, guys, quiz is 5%. Okay, you either know it or you don't. But what's like important is for the midterm. So like all the key, like I'm trying to help you like formulate your answers for the midterm, and then for the next one, which is the midterm review, we're going to be doing a lot of like, let's say, management assertions, because those are going to be coming a lot. So I think Jack Martin likes to use like questions that you have to like attend class. So like if you hadn't attended, like I hope that I gave you some like inputs on like what the class is. If you're with Prof Alex, I hope like some of the questions are from like the exercises. Otherwise, is there any last question? I know Elizabeth, you had a question. We could stay at the end for
No,
you guys.
it's okay. I was able to
good?
figure it out. I'm all good, Danny. Thank you.
Perfect. If there's anything, guys, just stay after, and I'll help you with it. Otherwise, you could leave and go sleep now. All right.
Just one question, Danny. This means that there's
Yeah.
no midterm review, right? Since
No,
it's so
there's
close
one.
to
There's
the quiz.
a.
Oh, there is.
Yeah,
Okay.
yeah.
Okay,
I'll try
great.
to. Because your midterm, I don't know. I'll check the outline to see if
It's November 5th. Sunday, November 5th.
Jesus
5th.
Christ, it's fast,
Yeah.
huh?
Yeah.
Okay,
Very
so I'll
soon.
do it. Yeah, because I think the first time the gap between quiz 1 and quiz 2 was really big, but the gap. Okay, I'll check if I have any exercises, but yeah, I'll still have one because it's important, and it might be not 3 hours, but I'll check for a date, and I'll put it on the Facebook group, and might even do a poll, make sure there's people there. Good?
Okay. Thank you. Yeah. Thank you.
No problem. Have a good one, guys.
Thank you. Have a good night.
Thank you, Patrick, for your participation. Ciao, guys. Ciao, ciao, ciao. And congrats on your Big 4 internships.